Well, thank you all for coming. I think this should be an informative panel. My esteemed colleagues here and my esteemed colleagues in the audience should be very well engaged. I won't run through introductions. I think I'll pause and let people describe what they do and who they are with the questions that I ask. So I'll start with you, Fabio. I'd like to talk about your investment strategies. You run a Bitcoin fund, an ETH fund, and a Delta neutral fund. Where's the growth there? Are you going to build on these products?
Yes, good morning. Well, good afternoon, everyone. Yes, we run like ECA SICAV, that is an award-winning market-neutral fund strategy, actually, that has been around since 2017. As he was mentioning, we have like the Bitcoin fund also and the ETH fund, that in a way are the share class of a market-neutral fund that is dollar-euro based. Now, I think what could be of interest of the platform is how we managed to get like a Bitcoin fund to produce yield. The whole idea was try to be, before the BlackRock ETF and the stuff arrived actually on the planet, we were thinking to produce something that was liquid, because Grayscale was not liquid at the time, and people could invest their Bitcoin and get yield. The basic is very simple. We get, like dollar or euro subscription. We convert in Bitcoin, Bitcoin derivatives, as a matter of fact. So we still have the dollar, and we use the dollar to do basis trading, ARB, cross-market ARB, anything that actually produces an yield that is totally market neutral and delta neutral. We can do this for Ethereum as well, and we are planning a gold fund as well. So
okay. Can I move to Seth, head of liquid strategies in crypto trading? How liquid are the markets? Does that not limit the amount of trading and what you can do with that?
So we've seen more and more liquidity come into crypto markets as each cycle progresses, and actually seeing that liquidity expand beyond just the top coins. So you're still talking hundreds of millions of dollars of capacity for liquid funds that are taking more of a fundamental focus and want to be able to risk manage. We're not quite into the billions range, depending on how tightly you want to manage the liquidity risk. But that's much better than where it was in prior cycles. And I'm obviously talking about a presumption of wanting to invest predominantly outside of Bitcoin and ETH, where those have much more plentiful liquidity. Just backing up a second on CoinFund, we have just about a billion AUM across 2 venture strategies and our liquid strategy. We take a fundamental approach to investing. We were founded in 2015 on the view that the technology that we were seeing emerge in the smart contracting realm and the Ethereum realm in particular was a big secular growth opportunity. And that's led to a number of expansions and investment opportunities, starting with pre-seed, seed, then Series A, and then adding liquid in 2000.
Okay, and moving to Anatoly. Crypto as a diversifier, how correlated is crypto and Bitcoin to itself and to other markets?
So first of all, we have to look at crypto as clearly a risk asset. And from that perspective, correlation to equities perhaps should be the highest. Having said that, it would be kind of a bit simplistic to look on the immediate correlation, say on a 24-hour basis. For various reasons, whenever an idiosyncratic event happens in equities, crypto reacts pretty painfully. And we've seen COVID crisis, we've seen August the 5th, yen unwinding. Every time equity markets sold off, crypto reacts with perhaps even higher beta, right? Having said that, the right framework would be to look at 60 days average, or even better, 6 months correlation. And I believe BlackRock in the most recent report took exactly this approach, looking at like how the correlation between equities and say Bitcoin works on the 6 months basis. And realistically, it oscillates around 0.2, going as high as 0.75 positive to minus 0.5 negative, right? but ultimately the oscillation is around not 0, but 0.2. So the reason crypto reacts so painfully to different events, first, it's 24/7 asset, right? And from that perspective, if you look on equities, equities would trade 6.5 hours a day, 5 days a week, which comes to 32 hours a week, which is roughly 19% uptime of the proper 24 hours window. So from that perspective, crypto trades 5 times larger in terms of number of hours of active trading, and realistically would react over the weekends, something equities would never react. Another important thing is circuit breakers. In traditional assets, in traditional markets, on both NASDAQ and NYSE, you would have circuit breakers, which at -7%, if the traditional equity markets were to sell off, there are going to be 15 minutes pause. If market sells by another 6% to -13, there are going to be another 15 minutes pause. And if it hits 20, there is suspension for the rest of the day. Crypto does not have this luxury. If it has to sell by 40%, it will. So from that perspective, realistically, it reacts in a more sensitive manner to any market events, but long-term correlation is relatively low, 0.2, and that should be factored in the portfolio construction.
Okay, thank you. And Robbie, look, last but not least, congratulations on ETF, one of the most successful products of all time. How is this marketed to your clients there? Is it an entry point into a new asset class? Is it a diversifier? How do you see that narrative? And it's obviously been successful.
Sure. Well, it's great to be here in the UAE and Dubai. Exciting to see all the great activity and innovation happening in the region. I'm Robbie Mitchnick. I'm the head of digital assets at BlackRock. And I guess maybe to start on your question, I'll follow up on what Anatoly said, and Anatoly and I are old friends now, and I'm a big fan of his, and you know what you guys have accomplished so far. Nickel is awesome. I have to disagree with you on crypto broadly as a, quote, risk asset, though, or as something that fundamentally makes sense to be correlated. I think it's really important to bifurcate between Bitcoin and the rest of crypto on that dimension. Bitcoin today obviously is about 60% of the whole crypto market cap, and uniquely has this position as an emerging global monetary alternative that actually fundamentally doesn't have a lot of reason to be correlated at all with traditional risk factors. And on some dimensions and for certain risks, you would actually expect it to be inversely correlated potentially on a fundamental basis. And we think about the rest of crypto, that's a different case, because most of the rest of crypto is more focused or more predicated on technology, innovation themes, and adoption of those. So it looks a little bit more like venture or tech equities, which you would expect to be more correlated.
Mm-hmm. Although long-term, there is no statistically significant evidence of correlation between equities and Bitcoin on the longer term, right?
Yeah, it's low. Yeah.
If I may, I agree entirely with what Robert said, actually. It's like, yeah, you have to distinguish Bitcoin and the rest. It's like two different worlds, actually. And, it's exactly what Anatoly. There is no, short-term correlation, yes. We all see it, and we can feel it, but not in the medium to long term, because it's decentralized, supply and demand, this kind of stuff. But all the other tokens is a different story. It's a tech play, it's like liquidity constraints, new project that keep coming out, and whatever you think is good is not going to be good in 1 month. Is totally different stuff.
Mm-hmm. Okay. Seth, Bitcoin, risk on, risk off?
So I think I don't have much to add to the discussion that just was laid out. I think over the long run, little correlation with equities. The interesting dynamic from an altcoin investing perspective, though, is you don't see altcoin bull markets without Bitcoin being in a bull market. But when you tend to see more risk on, the bull market shifts from being more Bitcoin focused to being altcoin focused. And one way of thinking about that is, and I wouldn't take this literally, but you kind of have a QT bull market, so a quantitative tightening bull market where you have markets recovering, some liquidity provision, but it's not, the spigots are fully open on liquidity, and that tends to be more of a Bitcoin bull market. That's what we've been having. And then when you get into a full-on liquidity provisioning bull market, think of that as the QE bull market, you tend to see a little bit of a shift from just Bitcoin and a few other assets to a much broader set of assets getting a bid. And that's, I didn't come up with that on my own. That's a guy, Ben Cowan, that does some work around the degree to which liquidity provisioning leads to more of an altcoin market.
I'd like to just develop on that a little bit. I mean, you come from the equity markets, you're using your knowledge and expertise on measuring how these things perform and porting that across. So does that port well across? I know when I looked at crypto trading, we looked at FX models and it didn't work, even though the infrastructure and the market seemed to be like FX. The models didn't work. So how have you found that, and does it port across all the categories of tokens that you trade?
So, well, a few different ways of thinking about this. One is in the equities world, particularly the fundamental equities world, we rarely talked about liquidity. So the degree to which liquidity or monetary and fiscal easing affects the crypto market is an extreme relative to the degree to which it affects the equities market. In the equities market, and I did fundamental equities investing for 18 years, large cap growth equities investing, you could kind of take it as a given that over any medium to long-term time horizon, there was sufficient liquidity and equities were trading more or less around fundamentals. But the fundamental analysis part is directly analogous. The fundamental analysis part of finding projects that have increasing adoption, increasing activity, a very large addressable market, where we can model out where we think their fees are going to go, what multiple they should trade at, come up with a price target. That process is really similar to what I was doing on the equity side. And I'd say there's even, you can take that analogy one step further and say there are a bunch of types of end markets in crypto today that don't have those directly measurable fundamentals, that don't have fee generation today. And what's interesting is you have an analogy to that in the equities world as well, where if a company isn't profitable, people look at revenue multiples. If you think about the dot-com boom, which obviously was a boom and then a bust after that, you had equities that were really just about, or the valuations were predicated on the amount of eyeballs going to websites. So the traction that you were seeing, even in many cases pre-monetization. And some of those names ended up doing well as they matured. Many of them did not. But I think you see the same appreciation of the long-term potential of a lot of verticals within crypto and a willingness to value them based on future potential. So fundamentals, very strong analogy to what I was doing in the equities world.
So if I may add, the concept is we are not reinventing the wheel. Whatever we are actually doing in traditional financial assets, we can do it in crypto. There are obviously features that are peculiar to the market. It is like liquidity constraint, high volatility, new project coming in and out, and all the time that actually require a different approach to, I mean, not to get burned, just to say, just to sum it up.
Mm-hmm. And continuing, Fabio, I mean, with your different products, do you see uptake across each of them, or are they more specific to specific clients? Are you cross-selling them all as a sort of global multi-strat? What's the vision of what you're selling to your clients?
So
Fabio?
is it me or not?
It's you.
Okay. Me?
Fabio.
Sorry, can you repeat the question? Sorry. I thought it was like to Anatoly.
I said, with the breadth of your products, right? So
Yeah.
are you selling all of these as sort of a multi-strat? Are you letting people pick and choose? Are you suggesting? How are people allocating funds into?
Okay. Let's put it this way. I mean, in my world, let's put it this way, the strategy is one, that is the market neutral, delta neutral. Then, the way we look at Bitcoin or Ethereum, for us, is just simply a different way of investing. It's simply a different asset class of the same fund. So you can invest in euro, in dollar, in Bitcoin or Ethereum, exactly the same. And you have a yield that is proportional. Obviously, if you invest in Bitcoin or Ethereum, you have a cost of funding because you have to transform back the ETH or the Bitcoin into dollar that you can use to do the market neutral strategy. Let's put it this way, from a client point of view, we have a very well diversified actually thing. But I think people, in our case, they come to us because we are very easy to put in a bucket. I'm coming, my firm has been around for over 20 years. And what I learn from investors is especially in traditional finance, they want to put you in a bucket, make sure that is exactly what you do, and you do not have any strategy drift. So we started 7 years ago with this in mind, and we just kept it like this.
Okay. And Anatoly, on strategies, what strategies can be added to increase the risk-adjusted returns on your portfolios for investors?
Yeah. So whilst naturally people who come to crypto look at crypto as a directional exposure, and thanks to BlackRock, who is onboarding now larger number of institutional clients into this Bitcoin play, Ethereum play, and I'm sure there are going to be more assets to come. I think there's also another angle, kind of a more elegant approach to risk management and portfolio constructions, hence the name of the panel, right? Whereby you are not expressing directional view on digital assets, but rather go in a market neutral, exactly to Fabio's point, right? And specifically, there is a great examples in traditional finance of multi-strat, multi-manager funds who are looking at the market in a non-directional fashion and extracting alpha from the underlying equities fixed income market. So you can apply a similar strategy to digital assets. And that has been our philosophy from the very beginning, that whilst directional exposure can be very impactful on yield or kind of a value appreciation, fundamentally not everyone is able to underwrite volatility of 60 to 80%. That's kind of naked crypto volatility. If, on the other hand, you can lower vol to 6 to 8% market neutral fashion, that opens far greater number of doors because it fits many portfolios. And I think the great examples on traditional space would be Millennium, Citadel, Point72, and behind each of these firms is this kind of incredibly stable source of returns. Millennium, for example, has been around for 35 years and had one negative year, which was 2008, with -3%, when market was -63%. And certainly this is kind of stability of returns appeals to capital allocators. Now, can you apply the same strategy to crypto? And the answer is absolutely. It wouldn't be possible, say, 10 years ago, but now with the evolution of derivative markets, you can build very complex strategies whereby you are hedging away market risk and you are focusing exclusively on alpha. And certainly that kind of brings more institutional demand into the space. In addition to directional exposure, which has the right to exist, it just you should be able to process this volatility and absorb this kind of 60 to 80% vol.
Okay. And Robbie, with the success of your tokenized money market fund, you're sort of etching into crypto portfolios product by product. What's next? What are you going to use DLT for to increase portfolio construction and settlement?
I didn't quite catch the last part there.
So you have a tokenized money market fund now, which is becoming also successful. What are the next products to tokenize in order to get into other people's portfolios?
Sure. Well, I think the reality is there's not yet a long list of actionable things that you would be able to tokenize that would have the kind of commercial uptake that our original foray has, because there's still a ways to go in terms of the readiness of the ecosystem for this. So if we think about the long-term potential of tokenization, that's something we're very excited about as a firm. We're investing significantly behind that. But the truth is today, it's still very early, and a lot still needs to happen before you really see the promise of tokenization realized across multiple asset classes and geographies to really transform markets in the way people hope will happen. And that includes the proliferation of institutional grade custody solutions, likely a combination of the existing crypto native custodians plus the large traditional bank custodians getting into this space. It includes having multiple or at least one very large credible trading venue that centralizes liquidity in tokenized assets. And to a certain extent, it also includes having a little bit of regulatory clarity around some of the issues associated with these, including sort of most basically, if you tokenize a bond, that's treated as a bond. If you tokenize an ETF, that's treated as an ETF, et cetera.
Okay, so to the panel and to follow on from that, now we're seeing successful crypto ETFs. A lot of you guys run crypto hedge funds. What's the big pulling point for the different products, and are they fighting for the same audience, or will you find natural segregation?
Well, not really, actually. It's like, the ETF has got a clear use case. It's liquid, it's tracking, it's regulated, it's listed. It's like it allows people to get in a, let's say, safe way, actually, in the crypto market, while before was a bit of a far west. Actually, in some aspects, it still is. Like, say, funds, hedge funds, like the one we are running, that is a Bitcoin, tracking Bitcoin plus alpha, is a total different beast. We don't have the same liquidity, so it's monthly instead of daily. Investors have a more of a long-term view. They don't use the instruments like simply for speculation. Because I think in ETF you can have like probably investors that are here for the long run and they just buy because they think it's going to go to 1 million, I don't know. And people who actually trade it like they trade equity. They just go in and they get out. And you can see in the short-term correlation with the equity market. You get subscription and redemption depending on how the market goes. So I don't think we are fighting for the same audience. It's like the amount of asset that can be deployed into the crypto ecosystem, in which you include use of the ETF, it is a traditional instrument, is huge. It's like, and I agree with Robert that actually says that we are still early. I don't think anybody should feel like we're running late. We're still very early in a lot of things in crypto.
I think what BlackRock did really kind of has removed this operational complexity in accessing crypto market. Yes. Because if you think from the perspective of an allocator prior to January this year, you have to overcome this idea of custody, opening some accounts with offshore exchanges. And it's something many people would never engage. For people like us who are professional trading crypto, we are comfortable holding underlying asset across multiple venues if the need be, and we are trading like 240 different assets. So from that perspective, for us, ETF is not something we are dependent on, but for 400 different institutional allocators, as disclosed in 13F, who bought into BlackRock, Fidelity, Franklin Templeton ETFs, that was the first ever exposure to crypto because it became so much more accessible. So we shouldn't underestimate the importance of FTX because it actually brings liquidity to the entire space.
Seth, do you want to chime in? Or?
Yeah, we love the Bitcoin ETFs and the access that they provide, but as I started earlier talking about how the development of the Ethereum ecosystem and smart contracting was really the technology that we were interested in engaging with, and kudos to BlackRock for launching an ETH ETF as well. We think there's a lot of interesting technology engagement outside of Bitcoin and ETH. There's almost a liquid venture component because projects go liquid at what's equivalent to the Series A or Series B stage in the traditional private market. So we love investing in the technology-driven parts of the ecosystem that are more mid-cap, smaller cap, But the second thing I'll say is, over time, we expect a regulatory regime out of the US that defines digital asset securities, what's a commodity and falls into a separate realm. And we think we'll then see a proliferation of tokens that are tied to real world businesses, much broader set than what we have today, which are predominantly focused on crypto native protocols. So we think there's going to continue to be an opportunity, a very fruitful opportunity to invest in fundamentally driven crypto tokens outside of the majors.
Fabio, you wanted to add?
Yeah, no, I just wanted to add that honestly here we all have to thank the approval of ETF and you guys, because you really open up the gates to a lot of people who are absolutely skeptical about even thinking about investing in crypto assets. But when the ETF arrived, the success that you guys had and whatever, it just made a lot of investors, a lot of allocators finally looking at the asset class and say, we cannot avoid it. And for that, to be honest, we have all to be thankful to them.
And we shouldn't avoid it. It's a crime against humanity not to have crypto in your portfolio.
Yeah, I agree on this one.
Because fundamentally, if you look on the portfolio construction, again, point of view, addition of Bitcoin on the level of 135% makes perfect sense. Not having one actually undermines the efficiency of the well-diversified portfolio. Because ultimately, if you can achieve higher returns with the same volatility and the same drawdown profile, you certainly should kind of invest, because that lifts your efficient frontier. And there is a very straightforward analytics, because we've run this for the last 12 years, kind of looking from 2012 until these days. If you were to have 60-40 portfolio as your base case, and then you add this kind of incrementally 135%, the question mark is like how it impacts your returns on the portfolio level, and B, how it impacts your volatility profile and drawdown profile. So the stats is as follows. If you have basic 60-40 portfolio, 60 being S&P 500 total return, and 40 being US Treasuries, in the naked scenario with no crypto, it has delivered 9.8% over the last 12 years on an annualized basis, which roughly comes to 199%, call it 200%. Then if you go in a kind of extreme allocation to crypto of 5% to Bitcoin, your annualized yield goes up to 14.6%, which is kind of a healthy 5 percentage point annual return. Now, if you look on the compounded basis, right, because of the compounding effect, actually your portfolio is up not 200%, but 396. Really? It's kind of additional yield of 200%? The question mark is like, what's your impact on your risk profile? The answer is vol remains at the same 10.1, 10.2%. Your drawdown profile goes slightly deeper from 21.5 to 22.3. Honestly, for 80 bips extra drawdown, I'm happy to take 200% extra return over 12 years. So fundamentally, that's what I'm saying. It's a crime against humanity not to have this exposure. And hopefully we're moving towards that.
So that claim, though, on a go-forward basis, rides on the idea that Bitcoin will continue to be largely uncorrelated, which we think fundamentally as a global non-centralized or non-sovereign, decentralized, scarce asset, that makes a lot of sense. But for some reason, the crypto community insists on labeling it as a risk asset or a risk-on asset, which is a little bit of a dubious framework to begin with, but especially when applied to Bitcoin. So it's been a bit of an own goal, because there's lots of reason to believe that it will be, a diversifier and potentially inversely correlated on some of these key risk factors, unless the industry succeeds in programming everyone to treat it as a risk asset by saying it so many times.
Robbie, I'd just like to say, crypto has been retail-led for this point, and even with the ETF, a lot of the volumes are sort of retail-driven. Do you see, where do you see a point where crypto may be institutionally led?
A lot of it comes back to the same thing. I don't have one institutional client meeting where the question of correlation doesn't come up. It's hugely important, and I think a lot of people in crypto, if they came from a more technical background instead of economics or finance, they often don't realize just how critical that is.
I think there was a quote, Bitcoin is everything you don't know about computers and everything you don't know about economics and money in one. All right, with that, thank you very much.
Thank you.
Thank you.
Thank you.